Welcome everyone to our June webinar. We are now on our sixth webinar so far this year, and we'll continue to do that on the second Tuesday of every month. And all the details will always show up on Eventbrite as we communicate with our investors. So today's topic is about flex space. We did talk about flex space a little bit last year when we got started in this segment. But just to recap really quickly, and I'll share some data points around each of these topics. But we know that the office space is really in a bad shape. And when we talk about flex space, a lot of people think that is this just another shared office space that we're talking about here, and we'll talk about the differences. Everybody sees and feel the high interest rates and the Fed combating the inflation, but still not controlling that inflation, and the economy is still growing and inflation still sticking. So that's there and to stay. And then combined with the rising construction cost, early on in the inflation side of things, rents were going up and everybody was enjoying the rent growth, kind of pacing inflation. But now rent is flattening, and now construction costs has increased, operation costs has increased. And so we started to see more pressures from the cost side of things, being that the rent is relatively flat. So I'll start with interest rates. I chose the 30 years mortgage rates. We don't use that for commercial finance, but everybody's familiar with the mortgage rates for their homes. I mean, I think I refinanced my house at the lowest point at a 2.5, I would say, in 2021. Right now, the interest is hovering around 7% for the mortgages. Although it dipped a little bit, everybody got excited about it, and now it's kind of getting stuck and sticky. So we see that the interest rates are here to stay. We may see a dip maybe early next year, but all indications that inflation is sticky and the Fed continues to see huge growth in the business side of things, on the GDP side of things, and on the new jobs. And so they're even thinking maybe we should have another hike, but like now they're just saying we're staying, and we don't see the huge impact on slowing down the economy. So with that, this is something that we're just going to have to live with as commercial real estate investors and in the industry. Interest rates is here to stay. On the other side, the office sector is really suffering, like I mentioned. The average, this is a Houston view. And you see here in the green line is the average vacancy for the office space. It's mind-boggling. I mean, this is actually showing a better view because it's averaging like the central business districts with the suburb offices that are kind of like the cooler, newer offices, class A in the suburbs. We've seen any numbers from 25 to 27% vacancy in the traditional high-rise office buildings, which is insane. And estimates are showing that they're probably going to continue to have oversupply for the next decade. So office is kind of dragging the whole commercial real estate space, even with the banks as well on the lending side. And it's not going anywhere. You can see here that the absorptions are actually negative on multiple years, and it's just probably going to improve a little bit towards 2026 and beyond, but the vacancies are going to continue to stay flat. So we share that because, yes, we don't play in the office space, but they have an impact on the lending environment and the perception of flex space being an office space, which is not. The other point is construction costs is not really a better story. I mean, if you compare, the gray line is the CPI, which is the consumer price index, which is the inflation basically of our services and goods. And you compare that to the construction cost, you can see that the construction cost rise is outpacing the inflation. So if you feel inflation in your day-to-day purchases, construction cost is double that in terms of like the lumber, the steel, and even the fixtures, whether imported or manufactured here in the US. So that's another pressure. So the pressure of interest for finance, the pressure of construction cost, and the flattening of rent, those combined kind of creates this environment where it doesn't make sense to do maybe new construction projects. And it kind of makes the acquisition of existing properties also more challenging with the mismatch of the seller's expectations and what we're willing to pay for a project to work. So with that, kind of we're looking at flex spaces. Is flex space the answer? How can we navigate these challenges and work through and continue to offer our investors the opportunity to invest in something that makes sense in this current environment? So what are flex spaces? So flex spaces, I call it the Airbnb of warehouses. It's like a combination of an open space where the tenant have the ability to design whatever space they want to work with. It's high ceiling, a small office typically included just for small, you know, interacting with their customers, etc. But it's rented by the pieces. So you'll see in a minute what kind of tenants we attract. But basically, you know, small businesses typically start maybe in a home garage, and you go from a home garage to maybe self-storage. And then from a self-storage, you want to rent a big warehouse. This is something in the middle where it's like a shopping center, but it's a bunch of warehouses. And people can grow as they grow their businesses, they grow into their need for these spaces. So some examples of the tenants we normally talk about. And so if you think about shopping centers, you have, you know, your restaurants, your cupcake, bakery, etc. Here, we're talking about small service businesses around your communities. And normally they're not really on main roads. They're kind of like tucked in a light industrial space. But you can think of your CrossFit gyms, your service businesses, your electrician, your plumber, your pest control, pool cleaners, etc. And then over time, we started to see other kinds of interesting tenants. We try to avoid automotive as they cause some, you know, anything that has oil or welding, we try to, or, you know, can cause fire, we try to stay away from. But nevertheless, you can see like maybe car tent, detail shops, etc. And we've seen anything from, you know, more like I saw an orthodontist doing his clinic in a flex space, chiropractic. And I'll talk about kind of the type of tenants we actually were surprised to have in our XSpace project that we did in Houston. But just kind of give you a sample of this. And obviously the main thing that is kind of changing the dynamic is the e-commerce company. With the rise of e-commerce, which I'll talk about in a second, that last mile delivery is requiring these local distributors to be around the houses. So they can do same day delivery that now we're enjoying when we do order e-commerce product. So that's also increasing the demand on what type of spaces and the kinds of flex spaces that are kind of, you can see here there's a wide variety of tenants requiring different type of setups, and offering them this open Canva, if you will, gives them the ability to create whatever they want out of it. And it's not a shopping center that kind of limit their ability. They don't really care about visibility on the road. They really care about more like the warehouse space. Here's a shot of a project that we're working on in Oklahoma City. We're kind of offering different sizes for different tenants. You know, a big tenant can have a big space. A small tenant can have one or multiple smaller spaces that can be combined. So why flex spaces? So now we understand what it is. So why does it matter? We talked about like expensive to build, interest rate is high. What's nice about flex spaces, there's not a lot of them around us. And historically, there has been, the big boxes, industrial warehouses, or maybe medium-sized warehouses, but there wasn't this small version of that you can grow into. And so the supply is low, and the demand, for all the reasons that I talked about, and we'll revisit with some charts, the demand is outpacing the supply. So that's a good combination. Keeps vacancy low. Anything is added to the market gets absorbed really quickly. We're beating the economic constraints. Construction cost, yes, is high, but these warehouses are typically cheaper to build than the rest of the bigger warehouses that may require more steel and concrete, or the residential home builder or apartment buildings where you need a lot more details on the finishes and the lumber as well. So relatively low cost to build, even though it doubled, still a lower cost to build. And we still enjoy that premium rent that kind of offset the increasing cost. So the combination of the three things really gives us a good reasoning why we should kind of grow into flex space, and that's kind of what we're working on right now. So sharing a little bit of statistics around the rise of e-commerce, everybody anecdotally feel that everybody is now more comfortable buying online. And you can see this huge spike over COVID. Before COVID, e-commerce was about 13%, growing at a 10 to 13%. Over COVID, it just exploded. And so now in every household, you feel like everybody is using e-commerce one way or the other, whether it's Amazon or other platforms. And even with that kind of huge spike over COVID, we continue to see the projection that the growth of e-commerce year on year is going to be 10 to 11% for the next decade or so. So people are just going to continue to buy more online and visit less retail shops. And retail industry is going to become more of an experiential thing where you want to experience something by going to a retail shop rather than going and buying something necessarily. So those combinations kind of making the shift away from retail, especially for goods, and kind of moving away into e-commerce delivery, last mile enablement by these micro distributors that are going to be around your neighborhoods. And that's our focus on the micro distributors. The second thing is, as I talked about the demand is very strong. As you can see in the orange lines here represent the huge spike in industrial demand. So I'm showing a Houston example. That's what we are based and we like to operate and continue. So Houston is an amazing market in all segments, but industrial, it's more so. There was a recent spike in supply to kind of catching that demand. It did impact vacancy a little bit, but if you could actually look at the levels of vacancy, they're really low, 6 to 7% on average in Houston, and it will continue to decline over the years. So demands will continue to be strong, and supply is still catching up with demand. So that's a good equation. And because of that, premium rent is a result. When you have a mismatch of supply and demand, rent will continue to increase. And that's what we like about this space. The other thing I would bring to your attention to is you can see here in the blue line and the orange lines, those are your traditional big boxes. Those are longer leases with strong tenants, and that's a plus. But the actual rent level is much lower than a flex space, which is the green line. And so you see here in Houston, the rise of rent for flex spaces, although just kind of flattening this year, is going to continue to rise over the next few years. And that's a good recipe as well. And when we actually build these projects, rent them out, and sell them down the road to a turnkey investor, we will see that this, although the interest is kind of increasing the cap rates and decreasing the market valuation temporarily, after that, we'll see a steep decline of cap rates. And that just translates into a much higher valuation. So a very healthy 7 to 7.5% cap rate when we're working on a project today. We like that because we're kind of catching, we're building now. So when we sell, we catch the decline in the cap rate, which is a higher valuation. So this is a perfect time to continue to be active in the commercial space, especially in the industrial segment, so we can catch a declining trend on the other side. Many of the investors that are maybe tied to one asset class are kind of like sitting on the sideline right now, not doing anything until they see what happens with the economy. Um, the last year, so we did the XSpace project here in Houston, and I would say, it was like a nice experiment. We're done the research. We wanted to build something that satisfies the need, but we didn't want to take the big risk. So what we did end up doing is a very niche product for high-end users in the highest income zip code in Houston and the Heights. And we are in the process, we're working on constructing the XSpace project. It was a build to sell, I would say luxury condos that presented this need of a space that can be customized to the needs. And what we saw even before we broke ground, about 30% of the units were pre-sold, and all kinds of tenants. Like I mentioned, that we saw the chiropractic person, we saw a tenant who sells fancy fish internationally, 3D toys, Marvel toys. So all kinds of tenants that actually surprised us beyond what we thought is more like focused on automotive and focused on storage spaces. We saw some tenants in the space of maybe it's a podcast studio, maybe it's a comedy club, maybe it's a gathering place for people to hang out. So you get to see these. Now, we don't allow people to live in them, obviously, but maybe they'll have a sleepover or hangover night. So some examples of that that are rendered based on the needs of the tenants and shared kind of experience spaces for them. The other thing so once we've done that project and we kind of felt it and it's already kind of exceeding our expectation, we said, okay, let's actually go back to the drawing board and do the basic, the bread and butter of FlexSpace, not the fancy one that was kind of nice. So we looked at, we're continue to be active in Houston, given the dynamics that I shared with you already. But we started to look into other spaces, other cities, other candidates where we can build flex spaces. And one of the main targets was Oklahoma City for us. I'm very familiar with Oklahoma City myself. I lived in Oklahoma for 12 years. We have a local team on the ground there. But also the dynamics of Oklahoma City is even more intriguing than most of Texas, I would say, which is really awesome. So we'll continue to focus on Houston, but we're targeting Oklahoma City. What's nice about Oklahoma City is it's naturally America's logistics hubs. It's centrally located, 3 major interstates crossing through Oklahoma City. And historically, it was an oil town. I was in oil and gas. That's why I was in Oklahoma City and moved to Houston because of oil and gas. But I would say after COVID, it's shaping up to be a more of an industrial hub, which it should have been. With Amazon and Walmart coming in and the expansion of the airport and the big industrial projects coming into town, we felt like this is a perfect place to build these smaller warehouses around the big warehouses that are growing right now. Oklahoma City is unique because it has higher paying jobs. Although like the growth of population is relatively mild, the wages are increasing significantly, and I'll share a chart about that. Obviously, the higher paying job requires more services around these residents, and that drives more demand for flex spaces. And if Supply was an issue in Texas. It's even a bigger issue in Oklahoma City, and that's why we're excited about it. The vacancy in Oklahoma City for flex spaces around 4% is an amazing number to look at. And unemployment is very low as well. So this chart kind of shows like the population growth in Oklahoma City, but the rise of median household income over the years. That gives us a good indication of the purchasing power and the need for service-based businesses around the residents. The other thing about the 4.5%, Oklahoma City, this is a half a year view, second half of 2023. It's about 1 million square footage worth of absorption on a yearly basis. Very strong demand indeed. So to sum it up, if you remember the Houston chart, Oklahoma is even stronger. So here's the vacancy in Oklahoma based on the supply demand charts. So supply and demand still supply is less than demand, and it's going to continue with the recent even addition of big industrial warehouses. It's still declining steeply, and it's going to be around 4.5% where when we have projects ready to exit the market. So I would say Oklahoma is positioned well for industrial, and we're excited about Oklahoma. We'll continue to dig deeper into Houston and Oklahoma for this sector. If you have been following us in InvestStream, we've been talking a lot about multifamily, and I would say multifamily is here to stay. It's what we know well, and we will continue to work on. But multifamily has its own challenges in 2024, so we're very careful and very selective of what projects we bring to our investors, and we feel like the market is correcting, and we're kind of anticipating a good wave of multifamily opportunities later this year. But at this point, we're kind of taking a pause and kind of looking at other opportunities outside of multifamily. So a little bit of comparison between multifamily and flex space. Multifamily, obviously, it's residential, 6 months to 12 months leases. As opposed to flex space, we're looking for established businesses. We're not looking for risky businesses that are startups that they can go out of business. And we're really looking for businesses that have been in the market and growing for the past 3 to 5 years, and kind of taking them to the next level and working with them. Multifamily, like I said, 6 to 12 months leases, which is great when there's huge inflation, because you can also increase the rents with inflation and pace that. But it's also, now that rent is kind of flat and inflation slowing down, you can't really adjust too much. For flex spaces, it's typically 3 to 5 years with predetermined rate increases on a yearly basis. So regardless of what's happening, those are locked leases with predetermined raises. Multifamily is now facing higher pressure on the operating expenses. Insurance has gone up. In some places in Texas, it's doubled. In some places in Florida, insurance has tripled. So that is adding a lot of pressure on the net operating profit. Real estate taxes is going up as well. Labor. So in general, operating expenses are increasing in multifamily, and the rents are being flat, so NOI is decreasing over time. With flex space, it's typically triple net, which means all operating expenses are passed through to the tenants. So that doesn't change the net collection from an real estate asset owner or management side of things. As I mentioned, multifamily, the rents are stabilizing. On the flex side, we continue to see that mismatch of supply and demand, and the rents are continuing to grow, and that's a healthy thing. Multifamily vacancy is increasing in certain asset classes. I would say Class C and Class A are seeing the most vacancy increases, and Class B is really solid. But overall, the average is vacancy is increasing. In flex spaces, it's the opposite. Vacancy continues to decline. Even with the recent kind of burst of supply in 2022 and 2023, vacancy will continue to shrink in the foreseeable future. And so we see this window of the next 5 years that we really want to be in this space before like everybody else jumps on it. Multifamily is a long hold. From a business plan point of view, we normally buy and hold for 5 years plus on the multifamily side to ensure that we have executed the business plan and we're waiting for the right market exit. And that's not necessarily a bad thing. It just makes the investment liquidity a little bit more challenging for people who wants to move to the next investment. With flex space, we typically do 1 to 3 years phases, and that gives more flexibility to the investors to move their money between projects. So more liquidity options, but people can continue to be in the space if they choose to. And then finally, with multifamily, it's typically limited exit options. If it's an acquisition, we buy it, we renovate and improve the property and the financials, and then wait to exit at the right time or refinance and continue to hold it, which is not a bad thing necessarily, but at least that's kind of like a predictable business plan. On the construction side of multifamily, we buy it, we lease it, and then we exit or refinance as well for a longer hold. What's nice about flex space, there's an element of land development in every project. So that gives us more opportunity to exit at different ways. We can build some spaces and lease them out and hold them, or exit some of them. But we can also develop the land for future investors to pick up the business plan and do other things that we already proven down the road. So we can sell land, we can build and rent and and exit that. We can divide the land, develop some of it, and keep the rest for a future developer. So it gives us more flexibility on how we can exit and kind of recoup our investment money and add to the multiples. So that was the end of my presentation. I'll touch base a little quickly on the assets that we already worked on. I already talked about XSpace being our flex space project that we are developing here in Houston. We also have another development project in multifamily. So all projects that we've done so far has been in Houston, whether it's acquisition or development. But we also have added a key resource to our team from Oklahoma City. My uncle Wes, he has been in the hospitality side of things and has been also in the commercial development space. And he's leading our local team and vendors as well in our next projects here in Oklahoma City. So we're adding the development arm and we're adding strong team locally in Oklahoma. So some of the projects that he worked on, building IHOP restaurants, Jack in the Box, shopping centers, and multifamily developments in Oklahoma City, which I would say are a lot more complicated than building a flex space, but nevertheless, it's all a great development experience. We'll wrap it up a little bit about us. I was in oil and gas for 15 years, and I'll share this with everyone, but been kind of in real estate now in the last 3 years, focusing on bringing alternative investments for our investors that, like to benefit from the real estate investment opportunities without being a landlord. Kind of this is our focus. We typically offer multifamily investments. Now we're growing into flex space and other opportunities in the medical space and in the senior housing. So that's a good segue for next month webinar. We're going to be talking about the other two asset classes that we really love and we want to grow into. Yusuf and Baha, my business partners, have been in multiple different businesses, focus on their core business of medicine, but also really serial entrepreneurs, and really excited about the partnership and kind of the continued growth that we've seen over the years. I told you about Wes, and we have also Marquise. He's a native Houstonian helping us on the acquisition side of land and properties here in Houston. And then finally, the rest of the team. Like I said, InvestStream is really focused on bringing those alternative investments, competitive returns for our investors, kind of all the benefits of real estate investing with minimum to no headaches. So with that, I'll open it up for questions. And Sammy, I don't know if we had anything in the chat so far.
No, nothing in the chat yet, but yeah, feel free to add questions in the chat or just unmute yourself to ask a question.
Hey, Ala, I have a quick question, if you don't mind. So, are there any limitations for using the flex space? Let us say, for example, I rent or I buy a flex space and I need to open arcades or I need to open bowling and open it for public and sell tickets. Is this allowed?
So this is something we control.
Uh-huh.
And the other thing would be the parking requirements. So if one of the two, if we allow it, but it violates the parking requirements, we're not gonna do that. The city will not allow us. And then we control it through the lease agreements with the tenants. Typically, we don't like high parking needs. We don't like anything with welding and potential fire. We don't like anything that can create a leak like oil. So we try to avoid like automotive shops. And then the other thing that we've seen is we don't allow people to build their homes inside the flex spaces. So as long as these kind of requirements are clearly in the HOA or in the leasing agreement, then kind of we avoid it that way. But the city would overrule, I would say, more on the fire side, on the fire marshal side, and on the parking side.
Good evening, Al. This is Naveed. How you doing?
I'm doing great.
I had an opportunity to meet you and really enjoyed your experience. I have one question. I'm based in Austin, Texas,
Okay.
which is not too far from Houston. I want to find out what is your prediction or your take on this flex office warehouse in Austin area now. It's great right now, but as you say, all good things must come to an end. What is your timeline? How much you are, how long do you think it's gonna be? 2, 3, 4, 5 years before it's gonna start getting saturated?
I mean, I can't speak to Austin specifically, but based on what I saw in Houston, Dallas, and Oklahoma City, I think we have a window of 3 to 7 years, assuming everybody's just gonna jump on this. It's gonna be eventually it's gonna be like the retail shopping centers everywhere, but there's this barrier to entry that people don't understand it well and don't understand the tenants need a little bit. So that is kind of keeping me excited. Like, hopefully it's not as fast as when people like build shopping centers everywhere and what they do that. So I would say maybe 5 years is a good, crystal ball answer. Now, Austin, I saw, the huge amount of development in the multifamily side of things. And that sort of hurt Austin a little bit in terms of oversaturating the market with new supply, but also increases the bases in an unsustainable way. So Austin is correcting faster, meaning everything is going to get discounted before it stabilizes more than what we saw in Houston and Dallas. But I'm not sure if that helps you on the flex space. I haven't done enough research in Austin. I typically try to avoid Austin until the West Coast and the East Coast kind of lift their hands off.
Thank you, I appreciate it.
We've got one question in the chat about the process of investing in flex spaces.
Sure, absolutely. I mean, the way we like to do things is we're always following the SEC regulation. So typically, this is just an educational session. You can scan the QR code and join our community. to learn more about more educational events, but also we can add you to our investors list. And every time we have a project, we will share our opportunities down the road. We typically have a project every 3 to 4 months. I wouldn't say it's all flex space, but kind of given where we're going next, it's going to be a significant portion of what we offer. But I would say keep watching what we send. If you scan the QR code, we'll add you to our investors list and we'll keep you posted on our projects. And obviously you can do the same with other sponsors that can bring these deals to the market as well. How often reports are provided for a project? Great question, James. Typically, when it's an acquisition project with existing tenants, we do provide a monthly operational and financial update to our investors. When it's a new construction project, we typically do a quarterly operational and financial report. So we share the updates, the pictures, what was done, what's next on the operational side, and then we share the financials. Very transparent sharing in terms of the P&L and the rent roll or the rent schedule.
Quick question, Al. Sorry. Once again, how much is your typical ROI? Let's say for Houston project.
So typically we have a very kind of methodical approach to our investments. So I would say if it's an acquisition, regardless of the asset class, we like to offer opportunities that are projected to double the money in 5 years. So I would say 80 to 100% in 5 years on every acquisition project, meaning we buy something with tenants and we take it to the next level type of project. On the construction side, it's typically a shorter cycle, maybe 3 to 4 years. And the average yearly is a little higher because you don't get tax benefits on the construction side. So we tend to find deals and put deals together that would give an average of 20 to 23% average yearly return. So the ROI on those would be anything from 60 to 80% over 3 to 4 years. Obviously, it's not flat. It's kind of like a ramp, or on the construction side, it's mainly at the end. But if you average it out, is anything from 16 to 18% to 20% on the acquisition, and anything from 20 to 23% on the construction.
Great, thanks.
One more question. Who manages the projects once acquired or built? Is it one particular company for all?
Great questions. Depends on the asset class. On the flex space side, we actually manage it in-house. It's typically a lower intensity management in terms of just finding the right tenants, doing the credit check, and making sure that they're strong, and we sign the long-term lease and just do basic maintenance on the property. When it comes to multifamily, we typically hire third-party professional management company that runs the day-to-day for our investments, and we meet with them weekly to make sure that we manage the KPIs and kind of attend to their needs from a CapEx or any issues that needs our attention. So I would say multifamily, 100+ units, big projects, we hire third-party professional management. On smaller retail, industrial projects, it's less intense and we manage it in-house. Great questions. Thank you. One other reminder, we have now, this would be our 6th webinar. We have 5 other ones that we uploaded to our YouTube channel. I encourage you to watch them. We talked about different topics in the multifamily, where we think the economy is going. There's different good topics that I encourage you to go through. We'll continue to do this on a monthly basis. Like I said, this would be the 2nd Tuesday of every month. And for the folks who are local to Houston, we actually do have our meetup here in Cypress the last Wednesday of every month. So we have a webinar the 2nd Tuesday and an actual physical meetup the last Wednesday of every month. With that, I'd like to thank everyone who joined today. It was an awesome session, great questions, and looking forward to seeing you in the July webinar. Have a great night.